Welcome everyone to the third update for 2025. My name is Shahrukh Abdali. I'm a financial advisor at Saturn Advice. First of all, apologies for the longer than planned gap since the second update. We'll try to be more regular going forward. I would encourage you to pause the video, have a read through the disclaimer, please. What I'll be talking about are two topics on which I've been receiving a lot of questions in recent times. First one is on the US and the longevity of the US as a dominant economy, and obviously the US share market being by far the largest share market of the world. To understand that, let's look into what has driven the US to this position of strength and dominance as we know it today. It all started with a positive outlook on the U.S. economy. This is called a positive feedback loop, as I've shown on the top, on the left side. Starts with the positive outlook that attracts capital from other regions. Money follows opportunity, and when you've got a positive outlook, a strong outlook on an economy, that means there are more opportunities and money flows in. Now, when money comes in, it needs to be converted into the local currency in order to be invested in local assets. In this instance, that was the US dollar. So the currency appreciates, which further enhances the return on the local assets. So obviously the assets will be generating a return, and that'll be further enhanced by the appreciation of the local currency for the foreign investor. So again, creates a perception of a positive outlook. And because money is flowing in, there is an abundance of money available for the local businesses to put towards expansion, which further enhances the opportunities available. So that creates an outlook for, positive outlook for the region again, and then attracts further capital inflows, and the cycle keeps going. So the US has been enjoying this positive feedback loop for the better part of the last 40 years, which has resulted in an utter dominance of the US share market, as I've shown in the chart on the right. The US share market represented about 30% of the global share markets back in the late 80s. As of now, it represents about 65% of the global share market. So hugely dominant position from about 40 years ago. The key question is whether this positive feedback loop is going to continue or reverse, and does that mean the dominance of the US will falter going forward? Now, there are obviously a lot of questions about the level of debt in the US system and the sustainability of that, plus the current government, President Trump, with his ever-changing direction in policy, doesn't give a lot of confidence on the outlook. And that is probably the key question. If the outlook loses strength, then the money stops flowing in or reduces to come in, and that then brings the level of debt and its sustainability into question. So yes, those concerns exist, but what I want to point out is some of the fundamentals, and the fundamentals are still pretty sanguine for the US. I've shown the US GDP growth rate in the top left. Sorry, the figures aren't really that clear, but I'll talk through it. The latest quarterly growth rate that came out about 3 weeks ago, late September, was a surprise on the upside at 3.8%. That is for the second quarter of 2025. So it is a very large ship, the US economy, the largest in the world, and it is continuing to grow. What I've also shown is the forward earnings chart alongside the US share market in the bottom right. That's going back 30 years. The blue line is the earnings expectations. The red line is the US share market. And what you can see here is The two are fairly correlated over this long period of time, about 30 years. And you can see on the top right, the blue line does not appear to be on the decline. So the earnings expectations are still growing. The earnings are expected to grow. And so far, even this year, the earnings that have come out by and large have been beating expectations or meeting the expectations at least. There are obviously those that the companies that haven't been able to meet the expectations and their share price has dropped accordingly. But the technology sector is still growing, still expected to grow at an above average rate compared to the other sectors. Probably the naysayers are pointing towards the slowing growth rate for the technology sector. And yes, the earnings growth rate is slowing, but despite the slowing, it is growing at a faster rate compared to the other sectors. So there isn't really, a very urgent negative outlook for the US as yet. What I would suggest is perhaps diversifying some of your US exposure to other regions, which are beginning to show a potential outperformance, potential for outperformance compared to the US, which could narrow the gap as such to the US share market. I'll talk a little bit more on that one just now, but what I want to caution against is the thought that it's time to exit the US because there's a credit crunch around the corner, which is going to blow up the US economy, and I know I would put better off taking my money out as soon as I can. I would highly caution against doing something as radical as that, i.e., taking all investments out of the US. The US is still a growing economy, it's the largest economy, and a lot of innovation is taking place there. So that could be quite a risky move to exit the US completely. The other big question that I've been dealing with is around AI, and in particular, whether the current AI rally is akin to the dot-com bubble of the late 90s. And why this question is coming about? Well, three things. Firstly, AI-related companies have significantly outperformed companies in other sectors. A lot of money has been pumped into AI-related companies and is continuously being, flowing into AI team. And thirdly, more importantly, as yet, there is no material monetary return to show for the capital investment that has been made in AI, which is akin to what was happening in the dot-com era, where companies came to the market with a brilliant idea of a product or a service that could be delivered using the revolutionary internet technology. It was a revolutionary technology back in the 90s as it was being developed. And, I absolutely have no, questions about AI being a revolutionary technology going forward. How it is going to affect our lives is probably the biggest question. And we do not know, as yet. I mean, going back to the late 90s, how many could foresee that we will have devices in our hands that we could use to do online shopping or navigate unfamiliar cities with ease, or talk to loved ones through video calls. All of that came after that dot-com bubble burst, and a lot of those companies had brilliant ideas, but no cash flow to show for the money that was being pumped into those companies faltered. Needless to say, there were a lot of companies that leveraged that revolutionary technology, and we are very familiar with those big technology names of present. And that is the important part that differentiates the current AI rally from the dot-com bubble. There are parts of the current AI rally where a lot of companies came about with a brilliant AI idea, and they have been able to raise a lot of money from the market and take on a fair bit of debt in order to deliver that brilliant promise on AI. But not all of those companies will be able to deliver. However, I've shown the 10 largest companies of present times by market cap on the rightmost table. 9 of those 10 companies are investing money into AI. And all of those companies are generating truckloads of cash, which is being used. Obviously, some of that cash, billions at that, is being used to develop AI and leverage their existing business model through AI. Now, that, in my view, is a much safer and more sustainable scenario compared to the dot-com era, where companies did not have cash flow. And as I've mentioned, there are those companies in present times that only have an AI idea, as yet no cash flow to show for it. But these companies that I've listed, the 10 largest companies, well, the 9 of the 10 largest that are putting money into AI, have existing businesses which are highly cash flow positive, and they are using their investment in AI to enhance those highly successful businesses, which I believe is a much safer bet. That said, if you are very concentrated into the AI trade, you certainly would have done pretty well. But I would suggest diversifying some of your AI exposure to other value-oriented and obviously recently underappreciated sectors. There are some really good businesses, solid businesses, cash flow generating businesses that haven't seen their share prices appreciate simply because they have not that much to do with AI. So maybe diversify a bit of your AI exposure away from into those sectors. But that said, again, do not exit the US, because the 10 largest companies that I've shown on that table on the rightmost, quite a few of those names are actually based in the US, and you would be, moving away from a lot of innovation into AI if you were to exit the US. So, what have the markets been doing? Or quite a bit of green there. This has been a good year so far. The S&P 500, which is the US share market in the top left, has returned over 13% so far this year. The bottom left is the equal weight of S&P 500, which highlights the fact that a lot of the rally this year has been driven by the largest companies, which happen to be the technology companies, and a lot of other sectors haven't really participated in this rally yet. So diversifying across to those sectors, there are some really good businesses there. Would be a good idea. They'll achieve a better outcome from the diversification perspective. I've shown the NZX 50, which is the New Zealand share market, in the top right. It's positive, but not by much, lagging the US share market, and by that account, quite a few other share markets across the globe, quite materially. Goes back to the fact that New Zealand is a very, very small market on the global landscape. Not a lot of breadth in terms of the industries and the types of companies that you can invest in the New Zealand share market. So a lot better to look overseas. Yes, have some exposure to New Zealand, but diversify across the globe. And that is what we do for our clients. Last one I've shown is the MSCI, which is a global share market exposure, X the US, so minus the US share market. And that takes me back to the first slide, where I suggested that it might be a good idea to diversify across other regions than the US by reducing some exposure to the US, as those regions are potentially beginning to outperform, and they might be narrowing the gap to the US over the medium term, if not longer term. Longer term, obviously, AI is going to drive the next super cycle. So whichever region, the companies that are able to leverage that will drive the returns going forward. Bringing it all together, I've already talked about reducing some exposure to the US in favor of other regions. If you are concentrated on AI, maybe consider lowering some of your AI exposure to other value non-AI sectors. Bottom line is there will be short-term volatility, and you need to be prepared to battle through that volatility if you want to capture long-term capital gains. If you have any questions, we are here to help you out in your asset allocation queries. If you want us to develop a portfolio for you, we specialize in constructing diversified portfolios. My details are there as well if you wanted to bounce off any ideas directly with me or wanted me to talk about anything in particular in my future videos. Until the next time, take care. I'll see you in the next video. Bye.